Hi, it's Andy Griffith here from RE/MAX Properties in Canandaiqua, New York. Welcome back to the video blog here. Today I wanted to talk to you about what effects do rising interest rates have on the real estate market. I've made some notes here to talk about that with you today. Before we go there, I'd like to point out a couple of things on this video blog that you can check out. Number one, there's a button down here below that talks about searching for homes. You can search for all available homes in the area by clicking on that button. Or if you have an interest in what your home's value is in today's market, there's also What's My Home Worth tab here that you can check out. So let's get back to our subject today. What effect does the potential for rising interest rates have on the real estate market? You know, I hear all the time recently, I read all the time recently that there's a high probability that interest rates are not going to stay as low as they have been the last few years. In fact, they're talking about the first quarter 2016, we may see a bit of an increase in interest rates. So what effect will that have in the real estate business? Wrote down a couple of thoughts. You know, the real estate business is most definitely affected by interest rates. Okay, when interest rates are low, favorable, the way they have been the last few years, typically real estate is very stable, and in some cases the values of real estate even will rise during these periods of time. As the interest rates rise, what happens is the purchasing power, of course, decreases. For every 1% that the interest rate increases, there's about a 12% decrease in the purchasing power that a buyer would have. Let me give you an example. If we have a buyer looking at a property, and let's just say they're going to go ahead and get a $150,000 mortgage at 4%, that particular payment, not including the taxes and insurance, but just the principal and interest, a 4% mortgage, 30 years, payment would be $716 and change. So let's look at what happens if the rate goes up just 1%. At 5%, that same $150,000 mortgage increases to $805.23. So if you look at the course of a loan, a 30-year loan, 360 months, that would cost the borrower another $32,079 over the course of that loan, if my math is correct. Please go ahead and check me. But what I'm really saying here is this. A buyer is not going to be able to buy as much home typically when the interest rates rise as they can today when they're still very, very favorable. The higher the interest rate, of course, the greater the payment. The greater the payment, the less money a buyer typically is going to be able to buy, unless, of course, they have enough income to be able to qualify for a larger monthly payment, or they're able to come up with more money to put down on the particular home or investment property that they look to buy. What does all this mean? In my opinion, the winter of 2015, the early spring of 2016 will be the very, very best time for you to buy a home in the very near future. Because if interest rates do in fact begin to rise the first quarter of 2016, then your purchasing power as a buyer definitely decreases. So once again, thank you for tuning in to our video blog, and please let me know if we can help you in any way. You can call me directly at 585-393-1300. Shoot me an email, andy@thegriffithteam.com, here at RE/MAX Properties in Canandaiqua. Have yourself a great day.